Hello everyone, welcome back to our channel. I'm Divyansh and today we will be talking about covered bonds. What are covered bonds, how they have relatively fewer risks compared to other bonds, and why they might be a good option for investors who are looking to diversify their portfolios. Before we discuss more on covered bonds, let's discuss what bonds are in the first place. A bond is simply a loan given to a company by an investor who in return is paid an interest on the money that they've loaned. When you have invested in a bond, you become a creditor to the company, which means the company now owes you money. Let's try and understand the concept of covered bonds through an NBFC. So NBFCs are non-banking financial companies. Some popular NBFCs include Dhanvarsha Finvest, Tata Capital, Muthoot Finance Limited, and many more. These NBFCs take a certain amount of money from banks and lend them at a higher interest rate to earn profits. NBFCs can also issue a bond called a covered bond. A covered bond is basically a bond with an extra layer of security, and these bondholders are given a higher preference if the company defaults. NBFCs also hold some loans in form of security that can be gold, house, vehicle loan, etc. This simply means that even if the NBFCs go bankrupt, these loans can be used to repay investors. There is also an SPV or special purpose vehicle which is set up. The aforementioned security is assigned to the SPV. In a circumstance where NBFC is not able to pay back the principal to its investors, the SPV makes the payment. Now let's talk about the risk factor. On the higher side of the risk grade, we have equities, which are risky in nature, but they give you very high returns. On the lower side of the risk grade, we've got government securities, fixed deposits, or recurring deposits. So covered bonds play the perfect balance by giving you higher returns than traditional investments like FDs, but at a risk level which is lesser than stocks or equity mutual funds. Primarily, we can associate three kinds of risks with this instrument. The first is liquidity risk. This is a risk wherein an investor may not be able to withdraw their money in the middle of investment term. The second risk is called credit risk. Credit risk involves non-payment of the amount that the investor has lent to NBFCs. The last is fraud risk. Fraud risks involve fraudulent transactions by NBFC. If NBFCs offer fraudulent loans that never existed, then the investor's money may be at stake. However, thorough due diligence is done in order to mitigate these risks. And let us tell you, covered bonds have never defaulted till now. This brings us to the last question. How can you invest in covered bonds? Well, the answer is pretty simple, right? Through Wint Wealth. Wint Wealth collaborates with NBFCs and issues covered bonds on their platform. Here you get the possibility of earning fixed returns which are between 9 to 11%, which is almost double of what you get from an FD. Covered bonds can be also a solid addition to investors who want to diversify their assets. But remember, this is not an alternative to fixed deposit. Earlier this month, SEBI came up with a regulation which can change the debt industry. For good, of course. According to the circular, the minimum investment amount for private issue is now 10 lakh rupees. Earlier, there was no such amount, but in a landmark decision, SEBI has opened up public issues, which means now investors can subscribe to these assets publicly, and there is no minimum investment amount. Think of this as an IPO for debt products. Earlier, the minimum issue size was 100 crores, and via Wint Wealth, you will be able to invest in these products publicly as well as privately. Well, this is all for today. We really hope you've enjoyed this video. Thank you so much for watching, and please don't forget to like, share, and subscribe to our channel. Till then, happy investing.